Hi, Matt McAleer, Director of Equity Strategies, July 28th, closing out that tricky month of July. Strength throughout this week and this month. One of the things we were concerned about was the high hurdle that some of the stocks had to jump over coming into earnings season. We had a rip right across the board in technology and a lot of consumer cyclicals. But for the most part, very solid numbers. Now, a couple names we had to endure a little pullback. Take Microsoft, for example. Probably got a little bit out ahead of themselves. We'll see over the next couple of weeks if the bounce in Microsoft today holds and they start rebasing to move higher. I thought the interesting headlines this week were really from overseas. You had China speaking about loosening in terms of government help for their economy, both public and private companies. That really goosed the Hong Kong and Taiwan markets. Big moves, 4, 5, 6% in China this week. In terms of what that does in our international portfolio, very helpful. We've been long South Korea, as you know. We've been long Taiwan. We've been long Japan. Asia tends to move together, not country per country per country, but they do tend to at least shadow each other in terms of ups and downs. So it's very, very positive to us that China had that move this week. The other is Japan. How about Japan? Finally talking about doing away with bond yield control, right? Japan's the lowest yields in the world. They were the last country to come up from negative yields. Now there's news out of Japan that from a monetary standpoint, they're going to let yields float a bit. They're not going to control yields. That'll be inflationary for Japan, and I think will be a positive for their equity market. We do have a international position in Japan. We may look to put some Japan in some of our portfolios that hold both domestic and international equities. So a lot of action, a lot of information out of the international markets this week. Not to mention our bond market, on Thursday with a 10, 12, 15 basis point move in Treasuries, came back some today. That was on the Japan news. Why? The thought being, if Japan, the anchor interest rate of the world, starts to come higher, that may create a scenario where the rest of yields climb. We'll see. There's still a long, long way from a Japanese 10-year bond at 55 basis points and a U.S. Treasury bond at 4%. I'm not so sure Japanese investors are going to be sellers of their foreign bonds and find that 55% rate on the 10-year in Japan so attractive. Probably take some time for that to work out. So, a lot of information. The market's always trying to share information with us. How we distill that, how we position, that's up to us as investors and traders. So now we're going to jump over to John, who's filming remote this week.
Hi, it's John Mousseau. I'm the CEO of Cumberland Advisors. It is Friday afternoon on July 28th. This week in bonds, a little bit of a rough week. 10-year bond pierced 4% on the upside yesterday before settling down. It's around a 397 or so on Friday afternoon, and that's up about 13 basis points on the week. Same with the 30-year bond, which is a little over 4%, also up 13 basis points on the week. Not so much damage on the short end. But what happened? Well, yesterday, Central Bank of Japan announced that they were going to be doing less yield curve control, that rates would probably rise somewhat. Now, this is with the Japanese government bond of 57 basis points. If you remember, for years it was almost zero. So it is definitely higher than it was, and it will probably go higher. And there was fear out there that Japanese investors who have invested around the world in search of higher yields may start to bring some of that money back home and away from the U.S. I'm a little skeptical on that just because of the yield differential that you see now between 57 basis points and basically almost 4% on the 10-year Treasury. But nonetheless, it made rates rise. The backdrop to this was Jay Powell on Wednesday, essentially giving you the report on they raised the Fed funds rate up to a 5.25 to 5.5 range. Everybody was expecting that. It's really about what's going to go forward. And he talked for a while, and in our view, didn't say a lot, but really just came back and said they're going to be data dependent going forward. If that's the case, then we got a real bit of good news today. We have a graph up showing the personal consumption expenditure. It is the favorite measure of the Fed in terms of inflation, more than the CPI and PPI. And why? Because the personal consumption expenditure, it really measures the stuff that people buy and in terms of like substitution effects. So if meat's really high and someone switches to chicken, that's reflected in the price levels. And so they think it's a more realistic view. That was a very good number, and that year-over-year number, as you can see from the graph, has declined just below 3%. And that was on a monthly number that was 0.2. So the good news is that that's the lowest monthly number since March of 2021. And that's an important date when you think about it in terms of that was when we started to see the inflation, get out of the bottle. The genie got out of the bottle. And why? Because everybody got out, were vaccinated, and got back out in the marketplace. And that is when we started to see more buying, money turning over, the velocity of money turning over. And we saw the inflation. We know the Fed said that inflation was transitory. It really wasn't. It was very sticky. But as you can see, it is starting to come down, and they have to be very pleased with that. And the 3-month numbers are also down, and those 3-month numbers are down to like 2.5%. What does this mean? It doesn't mean much if we don't see continued progress when we get CPI numbers in the next couple of months and see how those do, and PPI numbers in the next couple of months. And the Fed may skip another rate hike and want to see how things are going on. The economy is still relatively strong, although, as we talked about last week, there's signs of slowdown no matter where you want to look, whether it's things like, for example, foreclosures on, autos, auto delinquencies, et cetera. There's one measure. The Conference Board's view of inflation was down. People are expecting to see inflation go down. We will know over the next few months. Munis this week, they were also up in yield a little bit, but only about half as much as Treasuries. And as we've said very often here, a lot of that is just because supply is down. But we continue to think that municipal bond yields are very attractive. We hope everybody has a really good week, and we'll see you next week. Thanks.
Thanks, John. Next week we head into August. August and September always give us some volatility in the equity markets, previously anyway. Let's see if that's the case this year. Enjoy the weekend.